This video is based partially on a recent article featured in the Felder Report. Markets and securities can be thought of in terms of three separate but interrelated dynamics: fundamentals, sentiment, and technicals. Fundamentals include things like earnings, net asset value, trends, and relative valuation. Sentiment is how investors feel towards something like the economy, and technicals are a way to view and analyze the price trend. Typically, a security or a market elevates in price as a result of good fundamentals. This then leads to positive sentiment and a strong uptrend. At some point, the valuation becomes overextended. Sentiment can become too bullish and then momentum reaches a peak. It's at this point the trend reverses. The stock or the market falls, but then the trend reverses once again after a period of time, and then the cycle repeats. Individually, these signals are valuable, but not nearly as valuable as when taken all together. So, let's take a look. First, the fundamentals. And here's a quote. The chart shows the market value of all publicly traded securities as a percentage of the country's business, that is, a percentage of GNP. The ratio has certain limitations in telling you what you need to know. Still, it is probably the best single measure of where valuations stand at any given moment. And that quote is from Warren Buffett. And this chart here from Advisor Perspectives is a slight variant of what Buffett was talking about. And so the single best measure of valuations, according to Warren Buffett, currently sits just off its highest reading in history. In other words, the stock market has never been as expensive as it is today. The current reading is primarily based on soaring valuations, but also the deteriorating fundamentals. What you should take from this chart is that not only does this mean forward returns will likely be poor, it also means, more importantly, that downside risk has also never been greater than it is today. And next is sentiment. And another quote. Even the most circumspect friend of the market would concede that the volume of brokers' loans collateraled by the securities purchased on margin, is a good index of the volume of speculation. And that is from John Kenneth Galbraith. So if the level of margin debt is indicative of the volume of speculation, then we might infer that just as we are witnessing unprecedented valuations, those extreme prices have been driven by extreme greed, the likes of which we haven't seen in generations, if ever before. And this chart, again from Advisor Perspectives, shows that along with the lofty valuations, margin debt marches step to step with the climb. And lastly, the technicals. And one more quote. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. But of course, that would be sheer folly. If you're a responsible participant in the market, you always want to know where the market is, whether it's hot and excitable or cold and stagnant. You want to know everything you can about the market to give you an edge. And that quote is from Bruce Kovner from the book Market Wizards. And by the way, that book is a very good read. In analyzing the strength of the trend, we can use a very simple metric like RSI. In the case of an 18-month RSI, oversold readings have proven to be good long-term entry points. Overbought readings, however, have merely indicated a strong uptrend that may last several more years. By this measure, the strength of the current uptrend peaked nearly 3 years ago and has only been weakening since, putting in a clear pattern of lower highs. In my opinion, the stock market will catch up to the RSI as it has so many times in the past. And when I say catch up to the RSI, I say that in jest. It will catch down. Together, these three indicators paint a picture of an extremely overvalued stock market, driven by a speculative euphoria, even while the price trend is running out of steam. It's the textbook definition of late cycle in the stock market and suggests investors ought to exercise a great deal of caution. Be prudent, be patient. And for today, that's Chudog Charts. Thank you.